Hi, I'm Bridget Costello, a wealth advisor here at Kayne Anderson Rudnick. I'm joined today by Spuds Powell, Managing Director, and Darnel Bentz, Senior Wealth Advisor. We're here today to talk about some common questions that come up during market downturns. Spuds, I'm going to give you the first question here today. What are some of the ways that Kayne Anderson Rudnick navigates market volatility?
Fortunately, since our inception back in 1984, we've proven to be really good at playing defense during difficult markets. And there's a variety of ways we've had success protecting our client capital during tough times. Within the equity markets, we've limited our clients' investments to the very highest quality businesses. Our focus is on companies that not only are profitable, but have consistently grown their profits through a broad range of economic environments. We typically limit our clients' investments to companies that have little, if any, debt. We invest in companies that have low fixed costs. That's beneficial during recessions when companies are looking to batten down the hatches. We've always placed a premium on the caliber of the management teams of the companies we invest in. And then finally, and probably most importantly, we're laser focused on investing in companies that have clearly defined competitive market advantages. We want to invest in companies that not only have had success in the past, but will be able to continue to fend off their competition moving forward. So focusing on these high quality businesses is one of the ways we've had success protecting our client capital, but there's a variety of other ways that we've had that success too.
Yes, I know as a Kayne Anderson Rudnick wealth advisor, we look to diversify into different asset classes to help clients lower volatility in their portfolios. Darnel, can you talk about some of the other asset classes that you use for your clients and how that helps?
Yeah, I think lately you've heard a lot about alternative investments. And how we think about alternative investments is really a catch-all term for everything that's not a traditional bond, stock, or cash equivalent. Some examples of these alternatives are private equity, private credit, infrastructure-related investments, private real estate debt, commodities, and many others. These alternative investments, what we've experienced over time is that investors that allocate part of their portfolio to these alternatives can have a number of different benefits. They can have improved income, they can have reduced volatility, they can have enhanced returns. And how we utilize them really depends on each investor's unique goals and needs. Everybody has unique liquidity needs, unique income needs, unique return goals. And so it's not an easy thing that we just use all alternatives. It's really about what's appropriate for each individual client and investor.
When I'm talking to clients about alternative investments, one of the things I mentioned is obviously it's very difficult to predict the future. But one of the things I can predict with a lot of confidence is there will be periods where equities and fixed income asset classes struggle. And so to the extent that you can allocate a portion of your portfolio into investments that perform very differently than equities and bonds and have the potential to perform well in some instances where either equities or bonds are misbehaving, that tends to translate into better longer-term risk-adjusted performance.
What we've seen lately too is that the public equity markets are the most concentrated that they've been in history. We have fewer and fewer publicly traded companies. So really limiting your investments to only the public markets, you're really missing out on the opportunity to invest in America as a whole. And so investing in private businesses, investing in private credit, investing in infrastructure, those things can have benefits in building a diversified portfolio.
During the inevitable tough periods in the equity markets, it can be really difficult not to let your emotions influence your investment decisions and to make mistakes that you'll regret in the future. What are some of the ways that you as wealth advisors help your clients during those difficult times?
I think first and foremost, it's important to validate what our clients are feeling. It's really easy to panic when the markets get volatile, but I think bringing them back to facts is important. And the facts of their long-term investment plan, their long-term financial plan, showing them the stress test of Monte Carlo simulations of returns in their financial plan, and that they're still going to be good in lots of different scenarios, because nobody can predict the future. The only thing we know is that the market will be volatile again, and that we've structured things to weather different market environments. And I always remind clients the facts of the market are the last 75 years, the market has averaged about 10% per year. But intra-year, we can have really volatile markets. We can have, on average, 14% declines intra-year for the equity market. So it's a fact that we will have volatility. It's a nature of the publicly traded markets to have volatility. And why you live with that volatility is you get higher expected returns over time by investing in the public equity markets.
Spuds, how would you address a client today who said, well, this time is different. This time is different than every other correction in the markets. I need to make a change.
Typically when I hear that phrase, it's sort of confirmation in my mind that this is a person who's heading down the trap of letting their fear influence their judgment. It's sort of a way that they're rationalizing that fear. And so I point out to those people, and really all of my clients, that the most common mistake investors make, and unfortunately it's one of the worst mistakes investors can make, is letting their fear influence their judgment. And I don't blame investors for getting nervous, because we live in a time where the media is more effective than ever before at feeding on our fears and our insecurities and our anxieties. So a lot of people get nervous, and I remind them that our country, our economy, and our capital markets have lived through a lot of really scary times. And fortunately, they've always proven to be very resilient. Every time the stock market's ever sold off, it's always stabilized, recovered, and gone on to set a new record high. So I will point out to investors that we have lived through a lot of scary times before. I also remind people that you want to avoid making the mistake of making short-sighted decisions. Sometimes people are inclined to sell really good investments just because they've underperformed recently and increase their exposure to investments that have done unusually well recently. It's not unusual for yesterday's lousy performer to become tomorrow's really sorry performer. I point out to people that not only do you want to be well diversified, you want to be disciplined about the diversification. You want to focus on performance over the medium to long term, and take short-term performance, whether it's unusually good or disappointing, with a pretty healthy grain of salt.
Yeah, I think in these uncertain market environments that we experience, the natural tendency for investors is to go to the worst case scenario when it's uncertain. They don't think about probabilities, they think about the possibility of the worst case scenario happening. And so what we want to do is bring them back, frame the discussion more around facts rather than emotions.
This was a great, productive discussion. It was a good reminder to remain disciplined, to stay diversified, and to not let your emotions dictate your investment decisions. Thank you, Darnel. Thank you, Spuds. Thank you for joining us.